with your question, execution here in first quarter on our Willow project was very important, and the project team delivered the key milestones that were required to ensure that this project remains on track, fully in support of a first oil in 2029. We saw really good progress up there. We ramped to roughly 2,400 people on the North Slope, which again reaffirms that this was our peak winter construction season. And again, a little bit of kudos to the folks up there. Really strong safety performance. We saw some really strong efficiencies in a broad span of work across those activities. So on that winter construction, we're now roughly 50%, if not slightly better, on completion of all of our civil scopes. So when you hear that, think roads, pads, bridges. And we've got about 80 miles of pipeline installed. And very importantly, we executed a horizontal directional drill underneath one of the key waterways, and that allows us to connect east-west pipelines. Again, continued build out of that infrastructure. And as you've heard from me before, really critical this year as well was that operations center pad. So those modules that we see lifted up there here last year, those are now set on the pad. We opened our Willow construction camp, and that becomes important because it allows us to begin construction work on the North Slope a bit more throughout the year as opposed to being completely confined to the winter season. And then outside of Alaska, engineering, fabrication on our processing modules, that continues to go well. And then, of course, key for us here this year, being our second major season on this project, is procurement activities and sourcing activities. And so we do expect to source and receive a bulk of the engineered equipment that's required to procure, again, for those process modules and as well as all this forward-looking work that we have on the slope. And so here by year-end, we'll have 90 to 95% of that work sourced, and that brings even more certainty just to understanding how this will continue to play out for us in a positive way. So again, peak capital, we guided you a bit to about a third of total spend here this year. Will be in the first 3 to 4 months of this year. We're seeing that actualize for us, and so we expect capital to continue to taper down through the remainder of the year.
Our next question comes from Lloyd Byrne with Jefferies.
Hey, good afternoon, everybody. And Bill, congratulations, and thank you for all your help over the years. Ryan, you talked a lot about what separates Conoco and the advantages you have going forward, including all the free cash you have coming. So would you use your balance sheet and your asset sales and lean in a little bit on going above that 45% return to shareholders going forward? Thanks.
Well, I think, Lloyd, I was trying to guide to sort of the 45% feels about right for where we are in the cycle. Obviously, at these kind of commodity prices, if you think about it, it may require a little bit of use of cash on the balance sheet. But as Bill described in his opening remarks, we stand in a pretty good shape. We think buying our shares makes sense right now. We're not going to drop off that at all. And a small factoid, in the last 4 to 5 months, we've bought nearly 20% of the Marathon shares back in. So, we think that's important, and we know that returns of capital are important, but I would probably anchor on the mid-45% of our CFO. And, that may have some impact on net debt, but we're not intending to borrow gross debt to do this.
Our next question comes from Scott Hanold with RBC Capital Markets.
Yeah, thanks. Congrats, Bill and Andy. And Bill, wish you well in your future endeavors. My question, and look, I don't want to belabor this sort of macro kind of question and what does Conoco do, but I'm going to try a bit of a different angle at it. And Ryan, you talked about the haves and have-nots, where Conoco is advantaged. But, if we do have a weaker macro environment, what do you think should happen in the industry? Should it be companies with higher cost of supply should be the first to cut, and companies like Conoco, show a little bit more resilience, or do larger companies like Conoco need to take a leadership role in making some of the first cuts?
Well, I think it's a great question, Scott. Obviously, the folks that don't have the kind of cost of supply sitting in their portfolio are going to find themselves cash strapped and return strapped. So they're, obviously the balance sheets are in pretty good shape across the industry, better than we were in the last downturn. But you'll see a lot of activity cut back, and presumably what you're talking about is a price outlook that is well below 60, so into the 50s or the low 50s. And I think you'll see even some of the larger companies. I think if we found ourselves thinking that the remainder of the year was going to be in the low 50s, we would be looking probably at additional scope kinds of opportunities within our company too. But again, we have to assess whether we think that's going to be here for a quarter or a month or 2 months, or is that kind of the new normal and lower for longer kind of view of this. So I go back to kind of our prevailing view of the macro, and that is, while demand has come off a little bit from our current thinking of 1 million barrels a day, it's still, our view in 25 is probably 8 million barrels, 0.8 million barrels of additional demand growth in 2025, and that's not stopping. And OPEC is doing their thing to put some softness in the market, but remind people, $60 is pretty close to our mid-cycle planning price. So you shouldn't expect a lot of things to change out of our company at these kinds of prices, because we're built for it. We can handle the volatility, got a great balance sheet. We know we're executing low-cost supply. We're delivering the efficiencies that Andy and Nick are driving and what Kirk talked about in the operating side of the business, and so we're really focused on doing that. Would we have to look at potentially doing something different at 50? Sure, we would. But that's not our view today, and doesn't represent where we think the market is going to be for the next few years. All things could change, but that's kind of why for us it's, don't whipsaw this thing too hard right now, and use some of the strengths that we have as a company, because we can, because of the portfolio that we're investing in and the opportunity set that's in front of us. So don't overreact, but don't put your head in the sand either.
Our next question comes from Ryan Todd with Piper Sandler.
Good, thanks. Maybe one on a follow-up on the Marathon integration. I think it would appear that it's going well, given your guidance on capital and operational cost reduction. So maybe can you talk about how that integration is going, what you're seeing on the operational front? You've called out Eagle Ford performance, so maybe any update would be great.
Hey Ryan, Andy here. I can start that one, and maybe Nick might have a couple of comments to add too. So to say, it really feels pretty good to have the first full quarter of Marathon, behind us, and things are going really well. The integration is tracking ahead of schedule. We're making great progress on our $1 billion of synergy captures, and we continue to find more opportunities as a combined company. It is actually one of the drivers to why we're able to lower our capital and operating guidance from the improvements we've announced today. What I'd say on the capital side is we're already delivering capital synergies of over $500 million. So that started day one. And what's particularly pleasing is we're continuing to see efficiency improvements come forward. An example I can give you, and maybe Nick can add to it, is that this quarter our teams achieved record drilling performance in Eagle Ford, and what was particularly pleasing about that is they were leveraging combined best practices from both companies. So they're the kinds of things that we're continuing to get. Then on the cost side of it, we're also ahead of schedule. We're seeing opportunities for additional synergies in areas that we really couldn't evaluate pre-close.
particularly on the commercial side of the business. Again, examples there would be, we've got opportunities in areas like crude blending and midstream contracts that we didn't have factored in that we can now see. And of course, we're actually realizing synergies in the first quarter from things like the debt transaction we did that lowered our interest costs and the day one employee exit. So that's right on track. As we previously guided, we'd expect to see the synergy pace accelerate during the second half of the year as we ramp up merging all the systems. We remain very confident that we're going to exit the year achieving the cost and S&J synergies for that run rate of $500 million. Maybe one just final comment I'll make is, we don't consider it a synergy because we think of it as a one-time, but we got tax benefits from this transaction too. Between the foreign tax credit utilization and the NOLs associated with Marathon, that's about $1 billion of incremental value that we're getting from the transaction above and beyond synergy. So, I would just say that we're really pleased with how things are going, and we're getting it integrated into our company, I think, pretty seamlessly.
Our next question comes from Betty Zhang with Barclays.
Good afternoon. Thank you for taking my question. Brian, really appreciate all the color on the cash return framework. If I'm hearing it, if the cash return is closer to the mid-40s of cash flow from ops going forward, if I could ask on the flip side of that, is it fair to think you will be more willing to let reinvestment rate run a bit higher given where you are in the investment cycle on the major capital projects? I guess what I'm trying to get to is there a level of outspend that you feel less comfortable for the next couple of years?
Well, I think we've kind of factored that into the plans that we've talked about, Betty. We're not, the absolute worst thing to do right now is to try to whipsaw these long cycle investments. So we're not trying to slow Willow down, or we're not trying to create inefficiencies in that, and we're not equally important, not trying to do that on the LNG side. So depending on where the price goes and what our CFO is, obviously our reinvestment rate will be a little bit higher as you kind of factor that in. But I'll remind you back, when we showed a 10-year plan, what we've done with the company, over time as our cash flow goes and free cash flow as these projects come on, the reinvestment rate falls, the break-even falls, the reinvestment rate falls, and that's really the reason why we're doing these projects to begin with. We can't always anticipate what the commodity price cycle is going to look like through that, but we know these projects are sub $40 cost of supply. They can compete, and they deliver a good rate of return based on our view of the mid-cycle price call because they're low cost of supply. So there's things shareholders should be wanting us to invest in for the future growth and development of the company. But there'll be some natural ups and downs in our reinvestment rate as we go through that. And the shorter cycle stuff is where we have the flexibility. And today we're choosing not to exercise that because we have a longer term view. But we always have that flexibility as we go forward.
Our next question comes from Paul Cheng with Scotiabank.
Hi, good morning.
Morning.
Bill, just want to say thank you that with all the insight and help over the number of years. And Andy, welcome to that. Congratulations on the new role. Brian, I don't know whether this is a fair question. If we look at your inventory in the lower 48, it's probably one of the best in the industry. But we have heard from a lot of your competitors talking about how we are in the late inning in the shale oil anyway, and inventory will become far more difficult. So with that in mind, do you think that Conoco needs to start more maybe aggressively diversify away from the lower 48 into your other area of operation? If you think that is a reasonable approach, with the potential downturn, typically opportunity arise, and which you have captured the opportunity in the past. So with that, is there any areas or asset type you would like to expand into or that substantially increase your existing position? Thank you.
Long detailed question, Paul. I think, look, cost of supply is our North Star. We're a bit indifferent as to gas, oil, U.S. lower 48, international. We like the diversity in the portfolio. All things being equal, there are areas you would like to grow to kind of offset the profile, maybe the unconventional. But look, it's all about the cost of supply first and foremost. And we like adding more resource that is low cost of supply into our portfolio and into our company. But inorganically doing that at this point, it's a pretty high bar in the company, because we obviously have we believe a differentiated portfolio, both in terms of the cost of supply and its depth and duration as well. So we don't need to do anything, but we watch the market, we monitor it, we know what we like and what we don't like. So we pay close attention to it, but we're first and foremost focused on delivering our plans and delivering what we've got in the portfolio and executing, whether it's in Norway, Alaska, Canada, lower 48, the Middle East, or the Far East. So having that diversity is important. We like it, but we're not trying to go after it if that ends up being a higher cost of supply. That just doesn't fit our model.
Our next question comes from Josh Silverstein with UBS.
Yeah, hey guys. My question was going to be on the percent of capital allocation to the long cycle projects going forward. Ryan, you mentioned the free cash flow is starting to increase going forward because the spending from these 4 big projects is starting to roll off. I think it's around 25% of the budget this year on those projects. Can you just talk about the capital allocation going forward? Does that 25% trend over the next few years towards 15%, or do you start backfilling some of these projects as they come online?
Yeah, Josh, look, when we tried to signal what the cash flow and free cash flow inflection is coming as these projects come online, I mean, we don't have another Willow and another big batch of LNG things sitting on the cupboard waiting to fall into the execution plan. So no, at this point, you ought to see the capital start ramping down commensurate with the completion of those projects, and the CFO going up as those projects come online, and the free cash flow going up at an even faster pace, because not only is the CFO coming up, we see a drop off in the capital that's being invested. That doesn't mean that we're starving Alaska and Norway and Canada, with investment. We're still investing in those base businesses just like we're doing today, and that continues. And then we're obviously investing in the lower 48, and over time would expect to see some ramping activity there as well over time. But that's all part of our base plan.
Our next question comes from Kevin McCurdy with Pickering Energy Partners.
Hey, good morning, and thanks for taking my question. Just on the quarter, I mean, it looks like you got a really good operational quarter, but cash flows kind of missed the mark a little bit, and to us, that looks to be driven by cash taxes. Can you talk a little bit about why the cash taxes were higher in the first quarter and what your outlook is for the remainder of the year? Thank you.
Well, thanks, Kevin. We wanted to get Bill in on this call, so that seems like an appropriate thing for Bill to talk about.
Yeah, I think I've got that one, Kevin. So first, let me just say thank you to everybody. It's been an absolute privilege for 39 years with the company. I've enjoyed working with our investors and the analyst community over the last 5 years, and you're in great hands. You know Andy really, really well. So one last time talking about taxes. So sure, we had some deferred tax movement in the quarter. And so let me just put this in total context. When we started the year, we gave guidance to an effective tax rate of 36 to 37% and an effective cash tax rate of 35 to 36%. Based on our updated forecast, our full year effective tax rate is in the high 30s. It's probably closer to right at 40%. That's due to a shift in the mix of income. We're seeing an increased percentage of our income in higher tax jurisdictions such as Norway and Libya. And so it's pretty normal when that happens for your effective tax rate to go up a bit. And then for the full year, as you spot, our cash tax rate is expected to be a bit higher. We're expecting it to be the same as our effective tax rate. That's due largely to some discrete deferred tax items related to the lower 48 dispositions, which showed up in this quarter. As you know, discrete items are really difficult to forecast. You can see them in our deferred tax headwind in our cash flow statements for this quarter. So we had a headwind rather than our normal tailwind for deferred taxes. Now, on an underlying basis, if you exclude those discrete items for the lower 48 dispositions, we're continuing to realize underlying deferred tax benefits from IDCs as normal, and the MRO NOLs that we've talked about, those are rolling through the system. But what you're really seeing here is a one-time discrete issue associated with dispositions in lower 48.
Our next question comes from Leo Mariani with Roth.
All right, why don't you just see if you guys could provide a little bit more color on the $500 million that was cut from the budget. Certainly understand that these areas were things that don't necessarily impact near-term production here, in 2025. But perhaps you could talk a little bit about more, kind of what these things were, what countries they were located in. It sounds like there could be a little bit of kind of medium-term, production impact, but presumably you can go and spend more money if prices recover on some of that eventually.
Sure, I can take that one. It's I think I kind of really gave the answer earlier. It's for lack of a better term, it's nits and nats basically, sort of all over our global portfolio. There's some a little bit of deflation and optimization. There's nothing here specifically that's having any production impact this year. And I'd also add that it has a negligible impact on production next year. So not really any one specific things that I would call out. It's an inventory list of the first things we do when we look to sort of where can we tighten the belt and reduce some capital, but nothing really of note I'd want to call out really spread across the entire company.
Yeah, that's what I would say, Leo. It's a bit in Kirk's area and in Nick's area, so it's not any one particular area or any one particular category.
Our next question comes from David Deckelbaum with TD Cowen.
Thank you all for taking my question today. I just wanted to follow up in the context of talking about lower cost of supply over time. You guys more or less completed your asset sale target post the Marathon deal with the most recent divestiture. How do you guys think about the cadence, if any, of non-core asset sales over the next few years, or do you feel like you've sort of optimized the portfolio at this point?
Yeah, David, I think we're always optimizing the portfolio, and I think as we kind of scrub the assets and scrub the portfolio, there's hundreds of millions to $500 million of asset sales that we do each year. Coming out of the Marathon transaction, we identified a couple $2 billion of targeted asset sales, so that probably is a little bit at the high end, but we're constantly testing all of our assets. We don't get in love with anything, and if the cost of supply of future investments start rising in those assets, we tell our teams, you've got time to figure it out. Is there technology, more efficiencies that we can bring in to make sure that those investments are competitive in the portfolio? If not, then sometimes the asset will move into a different category in the company, and we'll look to move it out of the portfolio if it makes sense. But I would say the big things, yes, have been done. It's just more the little cleanup things that we do just really every year.
That concludes today's question and answer session. This will conclude today's conference call. Thank you for participating. You may now disconnect.